Hey everybody, it's Mark Yegi. Today we're going to be talking about the secret behind in-the-money covered calls. I'm kind of known as the in-the-money covered call guy, although I do at-the-money and out-of-the-money covered calls as well. It's just that the in-the-money covered calls are the more conservative of the three choices. But we're going to go into all of these things so that you can learn why in-the-money covered calls are good. The first thing I have to say is that this video is for educational and informational purposes only, and this is not financial advice, it's not investment advice, it's not legal advice. I'm just providing some information here on this video. So without further ado, let's go. You know there's risks involved in doing any of this stuff. So here's what we're going to be talking about: why covered calls in the money are where it's at and why they work, how they work and how I do them, and how to select your strike prices, and a couple of alternative strategies, and then we got a couple of FAQs that I'm going to handle. So if you stick to the end, we'll do all the FAQs, and then I'll kind of show you throughout the way we're doing this how we do it. So here we go. Here's my thing. If you can stay in the money, you can help reduce some downside impact. That's just the way covered calls work. If you're in the money, you don't lose any of the money until it starts to go below your strike price. And that's the math that's going to bear out. And I'll show you how that works. Now, I have a program called the Cashflowmachine that I teach students how to do this all the time. But you've got to have some system, some framework. And so the framework that we have and that we teach people is you have to start with the right stock. Then we go into the right market. If you have the right stock in the right market, the market's like a tailwind. And then we look for that right spot on the chart, and then we squeeze the juice. Listen, it's not perfect, doesn't always print money, but it is a good way to make kind of dividend income from your assets, from your stocks. So those are the cornerstones that anybody that's teaching on this subject should have as part of their curriculum. This chart is what I show to people in our program. This is the in the money, at the money, out of the money chart. Now, at the money, you're going to get the highest juice, but on the left side of it, you get less juice, but you get all these other benefits: more sleep, more security, fewer adjustments, more consistency, increased protection, less loss if the stock goes down because you're protected to the extent of your intrinsic value, your in the money amount. On the right side of that center is the gambler, the out of the money. And this is why I shy away from that a lot, especially if you're new to this, because in the money is more of the protector. And you'll see how this kind of works as we go forward. Now, our philosophy in the cash flow machine is this: we look for income, control, consistency. So we're looking for that predictable cash flow because we're not Nostradamus, right? None of us really knows which way the stock market is going. And so we're not going to try to guess. We try to get the probabilities on our side, but since we don't know for sure which way the market's going, which way the stock is going, we try to put probabilities on our side. We also try to minimize drama and maximize discipline. I believe everybody needs to have a trading plan, and you need to have a trading plan that has all the contingencies in there. What happens if the market goes down? What happens if it goes up? Where are you doing your trade adjustments? Where are you playing defense? Where are you playing offense? In the money calls are the engine of the machine, okay? So if you've been in the options market, you know that this is a very popular chart. And you can see, as it goes from left to right, you can see the angle dives towards the expiration date. Now, whether it's 90 days, 90 weeks, 90 months, 90 minutes, it's the same chart, right? The closer we get to expiration, the quicker the time decay accelerates the decay. And what that's good is, if you're a option seller, then you get that time decay because we sell first and we buy back at a later price, hopefully near zero, if it's time decay that we're talking about. So remember this chart, because this is the chart for option sellers that helps work in our favor. Now, in the money versus the out of the money mindset. Now, out of the money mindset basically means you're trying to play that Nostradamus role. You're trying to guess that stocks are doing this or the company is doing that and all this fundamental stuff. And really, at the end of the day, nobody really knows. And that's what most people invest in, right? They gear their investments towards stocks going up and they're going to make 10x or whatever. I just don't know that many people that have been in Apple for 20 years or 10 years. And so if you're going to be waiting in a stock, you might as well get some cash flow. And so in the money is capturing premium with higher certainty. The more in the money amount you are, the less you make, but it's still pretty good. But historically, it can offer more stability in premium capture. I don't know. I like higher certainty at certain times in the market. And in the money trading aligns with conservative and a repeatable strategy. So stick with me. I'm going to get through this, okay? Why does in the money work? Well, you get higher upfront premiums. That premium can offset some downside movement depending on conditions. You get the greater assignment probability, which a lot of people don't like, and that's a downside for this. And then you get the built-in downside cushion. So you want to be able to protect the downside first and then make a little bit of money second. So most people just go about this the wrong way and they're all trying to make money, but you got to protect the downside. You just have to protect the downside. So what is the strike selection strategy that we use? We look at deltas that lean more conservative and we evaluate the yield range appropriate for our overall risk tolerance. We try to avoid earnings because those are the 4 riskiest days in the market for a stock is, when you know earnings are coming up, you might as well protect yourself. And we use some technical support zones as well. Now, here, if you're new to options, I just want to explain, and maybe if you're not new to options, this will help you kind of carve out a nuance or a distinction, is today an option premium is made up of the intrinsic value plus the extrinsic value, okay? The extrinsic value is the juice, I call it, but it's the out of the money amount. The intrinsic value is the in the money amount, okay? And then at expiration, extrinsic value will always decline. Remember that little chart that I showed you that declines towards expiration? That extrinsic value of an option is declining. And so if we sell high, we have to buy back low later. We like to buy ideally back near zero. And so we're getting that yellow spot, right? The in the money amount is the in the money amount. If the stock is in the money by $10, it's in the money by $10. If it's in the money by zero, it's zero. But the bottom line is the in the money amount we can't do much about. That's the stock movement itself. What we can do something about is the juice, the extrinsic value. Okay, so give me an example. We've got a stock at 100, we've got a $95 option, and that's $7 today. Well, $5 of that is in the money. 95 minus 100 is $5, and then there's $2 worth of juice. $2 worth of extrinsic value, which is declining in value. That's the amount of money that we're using to look at how much income we can possibly get, right? So at expiration, we get that whatever is left in juice, which is very little because it's at expiration, it's zero basically. And then whatever the in the money amount is, that's what it is. So if the stock went up $10, well, there's $10 more in the money amount from there. So that's kind of how it works. Let me show you how it works on an option chain. Hey guys, sorry, but I can't show you this example on this platform. If you want to see the full example and the math behind this, I show it all on my video gallery on my website. Head on over to cashflowmachine.net/videos. By the way, you can note the time so that you can skip right to it for the example. See you over there. So the trade life cycle is simple. Your entry, then you're going to capture the premium, and then you're going to roll it or you're going to let it get assigned, meaning it's in the money, so you're going to let them take the stock from you. And that's okay. And so you have decision checkpoints here at the 7th day, maybe 3 days, 1 day before expiration, times that you need to maybe take some action in this. So that's if you just do a straight covered call option on NVIDIA. But what if you used leaps instead of the covered call, right? Instead of the stock. Hey guys, sorry, but I can't show you this example on this platform. If you want to see the full example and the math behind this, I show it all on my video gallery on my website. Head on over to cashflowmachine.net/videos. By the way, you can note the time so that you can skip right to it for the example. See you over there. By the way, I made a video, this video right here, and it's on the QQQ, and it just kind of goes through the similar thing and shows you that there's a way to make per year on the QQQ. Yeah, it's a bit older video, but you get the whole point. Anyway, listen, I tell people don't dig a hole in front of you, okay? Because you can make this juice, but if you're in a declining stock and you're not deep in the money to protect against a decline below that strike price, well, you're digging a hole in front of yourself. So I like to imagine we're on this path and there's trees on both sides of the path, but the only way to get to the destination is to stay on the path. If you dig a hole in front of you by losing money, by being out of the money and not having maybe protection, then you dig a hole and you have to fill that hole back in. So let's not dig a hole in front of ourselves, because the time element is the most important thing here. By maybe make a little bit less money each week or each month, but have a higher degree of certainty that you're going to make that money and keep it, and the stock is not going to take it away from you by doing a big decline. Make sense? So don't dig a hole in front of yourself. Now, at this point, there's a lot of people that have some preconceived notions that may be taught by other people, or maybe they've read things. But we really go into the in-the-money strategy, and that creates some funk in people's brains. So one of the things is that in the money means low return. We can look at that and say, I don't know what low return is for you, but if you're deep in the money and you're making 1% in a week on the juice itself, well, I don't know if that's low return. If you do 50 weeks times 1%, well, you can do the math on that. Is that low return for you? To me, it seems pretty good. Even if you do half that, it still seems pretty good. Assignment is bad. So some people are afraid of getting assigned the stock, and that means, you're in the money, so they're going to assign you the stock because they want that stock. Well, so what? They want your stock from you. Great. You get assigned, you make the maximum profit. If you're worried about taxes and other things like that, like my accountant says, there's worse things than paying taxes. But if you're worried about that, then just make sure there's not a lot of assignment risk, which means you have to have some juice left in your call, right before somebody decides to make that assignment. And so you can roll it to the next week or the next month and make sure you get some juice back in that, because then they probably, won't assign it. It's just a much lower chance of getting assigned. By the way, I rarely get assigned. I'm in the money almost all the time on a lot of my trades. So assignment is not that bad to me if it does happen, but it happens pretty rarely. You miss the upside. Absolutely. I just talked about that. You do miss the upside. If you want the upside, don't do covered calls. Covered calls are not about the upside. They're about income. It's a different mentality. You want the upside, do something different, right? But in exchange for giving up that upside, you capture certainty. And I think that's pretty important in investing. Strategic layering means combining in-the-money calls with leaps. Maybe you use these across your IRA, your margin, your cash accounts. Of course, don't put all your eggs in one basket, but this is a way to layer things. And then for tax efficiency and capital rotation, you kind of mitigate your risk by layering things, and that takes advantage of the different market conditions as well. So some FAQs that we have at this point, and maybe you're thinking about these and maybe you're not, but if you're not, I'm going to put them in your head anyway. What if the stock goes up, Mark? Well, that's a big one. And I want to be in a stock that goes up. In fact, if I'm in the money the whole time, like I said earlier, it's really hard to drop money, right? I want to be in the money. And so if the stock goes up, the base position goes up too, especially if you just have stock. Your stock goes up $10, it's great. Your option goes against you by $10, but you got some juice too, right? And that juice is not going to go up by $10. That juice declines towards expiration in general. So that is not the biggest risk in this trading strategy, is the stock going up. In fact, you welcome it. You give it a big old hug. Thank you for going up because I made my max profit on this, right? Because your base position moves up to offset. Okay. So that's a big thing that comes up, and people, it's a hard thing for you to get your brain around. I understand. But if you sit down and actually do the math and say the stock goes up $1,000. Well, you make $1,000 on your base position and you drop $1,000 on the in-the-money call amount, but you still keep the juice. It's the same amount of juice that if the stock didn't go up, you would make. That is how, just to sit down and do the math rather than doubting it, because it does make sense. If you look at the extrinsic value as the income amount, the juice amount, that's what we're making, and that's what we're calculating here. But won't I get assigned, Mark? Won't I get exercised? Yeah, so what is the first thing I say. If you get exercised, you can go back in the next day. It rarely happens, at least for me. On a dividend stock, it might happen more often because the buyer of that option may want to take advantage of the dividends. If it happens, you can just put a similar position on the next day. It's really not a big deal. It's a big deal if it's never happened to you, because you got to go reverse the trades and all that kind of stuff. And it can seem like a big deal, but after you've done it twice, you learned it. So what are some of the takeaways that we have here? Number one, in-the-money calls are basically about disciplined cash flow and an income strategy. Okay, this is not a growth strategy, and it's ideal for traders who value control and consistency. And that's what at least I'm after, and a lot of the traders that I talk to and teach are after as well. So if you want to join me on this educational ride, I'd love to have you. Subscribe to the Cashflow Machine. And if you like and comment on this video, if you got some comments or questions, great. If you want to give me a thumbs up, awesome. If you want to give me a thumbs down, you can do that. That's great. Just tell me why you're giving me a thumbs down. I'm always trying to improve my videos. And so if you are going to criticize me, awesome. I'm totally cool with that, but just tell me what I can improve. Maybe it's the sound quality. Maybe you don't like my head and you want me to wear a wig. Whatever it is, I'm down with that. I just want to, have some constructive criticism. Join the movement. We have a website called cashflowmachine.net. You can certainly go over there and you can join our Insider Tips newsletter. It's a free newsletter, and there are things that I can't talk about here that I talk about there. And so you may want to join that newsletter. It's free, and there's a QR code at the bottom here. So bottom line is, I hope this kind of enlightened you on a way to make income from the stock market. And the deeper you go in the money, the more quote unquote certain that we are that we're going to keep all that income, because you're protected to the downside to the extent you get that premium when you sell the option. I hope that makes sense. If not, that's cool. I have other videos. Check out this video right here, and we'll go from there. But thanks for joining me on this educational ride, and I'll see you on the next one. By the way, if you want to see how this all works, I created a free mini course for you called the 4-Step Cash Flow Blueprint. Just go to this link or the one in the description, and we'll deliver it right to your email. I'll see you soon. This content is for educational purposes only and is not financial advice.